Alrighty, we're back at the computer. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding. Thank you so much for tuning in with me here today. If this is the first time you are joining in on YouTube, make sure you hit that subscribe button. Thumbs this video up. We are bringing a ton of content. We're doing a little bit of a revamp of the content that we put out. We are planning on having other individuals to come on the podcast more often that we like and respect, just to really bring a different perspective and really just continue to, grow the following, grow the content, and just do the best that we possibly can. If you hit that subscribe button, it will notify you every time that we upload a podcast or a video onto YouTube. Then I would say Twitter is probably the best place to get everything that I do put out. A lot of times I'll just find or come across something that looks interesting and I'll tweet it out. And if you want to get access to that, you could follow me at Focus Compound on Twitter. So in every single video and podcast that Geoff and I do, when we talk about our investing style, we always talk about how we focus so much on predictable businesses and just predictability in general. And the reason for that is because if you believe that the value of anything financially related is the present value of the amount of cash you could take out over an asset's lifetime, you're dealing a lot with the future, right? That's all a stock price is it's forecasting the future. And we want to stick to predictable businesses because the future is uncertain. But as I've said in the past videos, you can use the past as a guide for the future. And if you are just staying involved with predictable companies, thinking about those future cash flows is a lot easier. When Warren Buffett and Charlie Munger say that they tend to stick away from technology companies because they don't understand them, they're not saying that I don't understand that Google, for example, a lot of people use it. You could search stuff on Google and it's an amazing search engine. They understand that. They probably understand the ad business better than anybody on the planet. But what they're saying is they just don't understand what the future cash flows could look like. And I think they would say that. So one thing that Geoff and I always do, we're going to do a margin analysis, and you could replicate this when it comes to return on invested capital or whatever measure you want to look at. But this is just something that Geoff and I always do every single time. I guess before we actually jump into it, I would say a predictable business is one that has a long historical streak of no EPS losses. They probably have positive free cash flow in most years and low volatility in margins, low volatilities in return on capital, and very few year-over-year sales declines. That's something that we typically look for. Everybody invests different, but we run a very concentrated investing strategy. So if our portfolio looks like, let's say, 5 to 8 stocks, well, we are going to want to feel much more certain about the businesses that we're investing in because, for example, we would not invest in airlines because we don't know what's going to happen in airlines, and that's okay. If we were running a more diversified portfolio with, maybe 20 to 40 different stocks, we'd probably think differently about it, but this is just the way that we do it. So one thing that we always do to judge a business's predictability is we always do sort of like a margin analysis. And like I said, you can do this on return on invested capital and whatever metric that you want to go over, but we're going to be taking the minimum, the maximum, the mean, the standard deviation, and the coefficient variation. And we'll go through one by one and I'll show you how we typically interpret these. I'm going to pull this down. We are using Costco for this example, really just because it's a very predictable business, one that everyone's familiar with. And I think it would just be good to demonstrate this. One thing that I will say that you should be thinking when you're doing, this type of analysis is keep asking yourself, why? Why are they able to do this? Why is this business predictable? Why are they constantly able to pump out the same numbers? Why are they able to do that? That's something that you should always be thinking when looking at companies because it really just helps you try to understand their business model and understand how they make money. A lot of times people, when they look at models or just numbers in general, they forget that this is a real business. So take the stock out of the business, think about this as a real business analyst, and just keep asking yourself why. I'm going to be pulling free cash flow here because I guess we'll do it on free cash flow margins as well. Really just because their free cash flow I think is actually better than their net income. So they have some sort of float going on, I believe. Yeah, it looks like it. But we could just do it on free cash flow as well. So what we'll want to do is we'll take the gross margins, and I am no Excel expert, and that's like totally okay. If you're an investment banker, you definitely know how to do all of this, which is awesome. But if not, then you could just follow along. So we'll take the gross margins, and this is pretty easy. This is just really plug and play. You divide the gross profit by the revenue. We'll do the EBIT numbers, operating profit by revenue, and then free cash flow margins. Okay. And then we'll turn that all to a percent. And we can copy it across, which is wonderful. Okay, perfect. So now that we have the margins down, one thing that we want to do when it comes to trying to figure out if a business is predictable is do our predictability analysis on those margins. So we'll do this for gross profit first, and I will show you what we do. Again, it's not that complicated, but it's just really how you interpret the data that's most important. And it's not supposed to be complicated. So you literally take the minimum of all the gross margins. Okay, and then you take the maximum of all the gross margins. And then you take the mean, which Geoff and I, we use just average. So it's the arithmetic mean in Excel. You do all of that, and then turn these all to percentages. And I'll explain in a second. The standard deviation. So we use stdev.p. You do that across. And then the coefficient variation is, and I'll change that to CV, is it's the standard deviation divided by the arithmetic mean. And I'll tell you what that means in a second. So this is going back to your stats class, and I'm sure this is all just a review for a lot of people. But for gross margins, the minimum gross margin that they have historically had since 2000 is 12%. The maximum is 13%. The average is 13%. The standard deviation is only 0.36. That's very predictable. And then the coefficient variation is 2.82%. Anything less than 30% is something that we like to see. So that just shows how predictable the gross margins at Costco are. And if I was starting this company and doing a lot of research on it, I would try to understand, why are they able to do this? Why are their gross margins so predictable? That is incredible predictability. So we could just do this across the board for EBIT margins and free cash flow. I will just stop the video now so you don't need to wait for that, and then we'll come back at it. All right, we're done. So we could look at the EBIT margins, and you'll see just how predictable this business is. And why this comes in handy, again, is because if you're going to be thinking about the future cash flows of the business, it will make it a lot easier to forecast if the business is incredibly predictable. So you could look at the EBIT margins, and you see that the minimum EBIT margin is 2%, the maximum was 3%, and the arithmetic mean was 3%, and the standard deviation of that was not even 1%, and the coefficient variation, so how much variance there was in the margins, it was only 7%. Like I said, anything less than 30 is very good, and this is on their EBIT margins. We can move down and talk about their free cash flow. Their minimum free cash flow was negative 1%, the maximum was 3%, and then the mean is 1% as well. So even though Costco is a very low margin business, it's still incredibly predictable. The standard deviation was 1%, and the coefficient variation was 71%, which makes that less predictable than the other metrics that were used above, but definitely pretty predictable nonetheless. And why this is interesting, because what somebody would probably do if they were going to build like a DCF off of this, or think about what the company could be earning in 5 to 10 years, is they would come over here and they would, draw out, maybe let's just do 5 years. And what they would do is they would draw their revenue on it. Let's say they think Costco could grow their revenue by 3% on average over the next 5 years. They will grow that out like that. And then you can take what you think is their average gross margin, because this is very predictable, so you feel fairly confident about it. And you could think that they're going to try to keep that consistent, and maybe they'll keep that at 13%. Now, I'm not familiar with Costco. Maybe people think that they could improve margins, or maybe they think that their revenue will grow by 5% or whatever. I don't know. But you can keep that constant and try to extrapolate that out in your quote unquote model. And you could also do that with operating income and all the way down to free cash flow. So this was just a quick tutorial going on how to think about predictability of businesses. It's good whenever you are taking a bunch of data to do a minimum, maximum, mean, standard deviation, and coefficient variation analysis on it to make you feel more certain in the predictability of the numbers. Now, you can look at this and say, well, Costco's business may be different from 2000 than it is on 2010. I understand that argument as well. So maybe you just take the numbers from 2010 onward. Again, I'm not that familiar with the actual business model itself and the fundamentals of it, so I don't really follow it or have much to say about it. But I do know it's a very predictable business, and this is one that I wanted to use for example. So my name is Andrew Kuhn with Focus Compounding. I want to thank you so much for tuning in with me here today. We love predictable businesses, and a good way to either screen for that or look for that is look for long historical streaks of no earnings per share losses, positive free cash flow in most years, low volatility in margins, which we just went over, low volatility in returns on capital, which is basically doing the same exact analysis on return on capital metrics, and I would say few year-over-year sales declines. Basically just looking for very low cyclicality in the numbers. And when we're doing that is because finance is all about the future, and of course the future is unknown, but you can use the past as a gauge to hopefully come close to approximate the future. So I want to thank you so much for tuning in. Make sure you hit that subscribe button, thumbs this video up, bringing you guys a ton of new content. Leave a comment down below if you want me to go over something. I hope this was instructive for you and you took something new away from it. And I can't wait to continue pumping out content. Have a great day, and we will see you in the next video.